Everybody, my name is Bennett Tchaikovsky, and welcome here. This video is copyright 2023 by Bennett Tchaikovsky. All rights are reserved. The opinions expressed herein are those of myself and not my employers, not including but not limited to Irvine Valley College in the South Orange County Community College District. This presentation does not constitute any legal or accounting advice or anything like that. Rather, what I'm here to kind of talk about today, and this really kind of goes to just whenever you're giving an explanation for something, we're going to talk about how numbers can be much louder or can be much greater than words. So let's go through, and this is something that a lot of my students kind of struggle with. And so this is a perfect time to kind of go through and take a look at this. So right over here, we have a balance sheet, and this is of the Home Depot. And when you typically look at this, and this is as of July 30th, 2023, and in the context of managerial accounting for the introductory class, there's a chapter on financial statement analysis. And oftentimes I will say to students, well, if you're given the option of two ratios, one being, say, inventory turnover, and the other one saying accounts receivable turnover, right? And what exactly do those two things mean? Well, if we say that, inventory turnover, which is going to be my cost of goods sold divided by my average my average inventory, which is my beginning plus my ending divided by 2. And I have AR turnover, my accounts receivable turnover, which is going to be over here. It's going to be my credit sales divided by my average accounts receivable. And when we are going through and making ratio selections, right, anybody can, when you're out in practice, it's not going to be that difficult to kind of sit down and figure out. It's like, okay, I can just like look these things up. But really, the more important question is, if you're going through and looking at a company's financial statements, which is what we're doing right over here with the Home Depot, how do we explain why we're choosing the ratio? So if I look at this right off the bat and I look at merchandise inventories, right, and this is part of the reason why we go through and say, okay, we want to look at, when we do something, we're going to create something called a common sized financial statement. What is a common size financial statement? This is when we take each of the balances and then divide it by the total amount of the assets on the balance sheet. And we're going to do this for everything that's over here. And then we're going to do the same for the prior year, or basically for the 6 months earlier. So this is going to be 27757 divided by 76445. And we're going to do this as a percentage, and we'll make this nice and okay. So we're coming over here and we're doing common sized financial statements. So what's the purpose of these? Well, if I ask you for the Home Depot, which ratio would you use? Would you use inventory turnover to analyze the company, or would you use accounts receivable turnover? Well, if you're looking at this right over here, which one would you choose? Which one is more materially significant to the company? And you're going to say, well, merchandise inventories is, because it's the bigger number. But when you're going through and saying, why are you choosing these two ratios? It's not enough to say, oh, I chose inventory turnover because inventory is a bigger number than accounts receivable, right? That's something that for my class is not going to get you very far. What you would want to say is something along the lines of, well, as inventory represents 30% of total assets, right? This is why we do common size financial statements, and accounts receivable represents only 5% of total assets. I believe that choosing the inventory turnover ratio would be a better ratio to measure Home Depot's performance. Okay, so it's not only, you don't want to just say, oh, I chose this. You have to quantify it. Quantifying it is very, very important. And you're going to find this, like, because if you're making an argument with a client or with you don't want to argue with your clients, but if you're making an argument within your firm, let the numbers do the talking. And that's really what this is really about. Like, let the numbers say, oh, well, I chose merchandise inventories because the number is bigger. Well, that's great, but tell them why. It's 30%. It's 6 times that of accounts receivable. And kind of the same at the same time too, as we're going through and looking at this, and this is their consolidated statements of earnings, which is another fancy way of saying the net income. And when we go through and look at the Home Depot, right, basically for them right over here, as we're kind of going through and looking at their numbers, they seem to be relatively like on the same path. But let's maybe go over to a company that's in a different type of situation to kind of talk about our next topic. So again, when you're going through and being asked to go through and say, why are you choosing something for my class, at least in managerial accounting, you want to make sure you're quantifying your reasoning. It's fine to say, oh, I chose inventory turnover, but that's not going to get you all the points. You need to go through and say, I chose it because it represents this particular percentage. Now, if we had a situation, I'll just go through and make something up. If, say, for example, net income, and let's say that net income was basically, and we'll do sales. This is a good one to do. So we'll say that sales would say over here, we'll use amounts in thousands. Okay, so the existing business, we'll say that they had sales of 2,000, and we'll say that the net income was, say, like 400. So again, we're kind of saying over here that these amounts are in thousand. The existing business has sales of 2,000. Now, for the new business, someone approaches you and says, oh, I want you to make this new product, or I want you to make an existing product, but I want you to make less money on it. And this new business would generate sales. In this example over here, we'll just say, we'll call it like 300, but the net income being generated from that, or the incremental income, would basically be at 5. Now, again, this is the way I teach this particular subject is going to be a little bit different. When you're going through and looking at this, some people would say, and a lot of the textbooks out there would say this, it's like, hey, if there's incremental income as a result of adding new business, go ahead and do it. It's a great idea. And I am very different. Why am I so different? Because if we're accepting new business, there's a lot of things we don't know. There's unknown. Have we done this before? There's a lot of things where we just don't know. But should we accept the new business? Well, you might say, well, it's positive. So yes, but I would argue this. The net margin of the existing business, and how do we define net margin? Or we should say, is that the right one? I think it is. Let's just check. I think it's right. The net profit margin is that's not, what's your net margin? It basically net profit divided by revenue. Okay, so that's where we're on the right track. Okay, so over here, I've got net income divided by my sales. And over here, my net income is going to be at 400 My sales for my existing business are going to be at 2,000. So this is going to be roughly 20%. So I have a 20% margin on my existing business. If I were to go through and accept the new business would incrementally give me another 1.6%. Now, again, a lot of accounting textbooks say, oh, you should go through and do it. No, there's a lot of risk, right? And so here, my risk for error is very small. If on this new business, if somehow I'm misestimating direct materials, direct labor, whatever may have you, I'm going to be in trouble. Now, should we accept this new business? If you say no, because my profit isn't as great, that's not going to get you anywhere in my class. What you need to go through and say, we would not accept the new business as the existing net margin is 20%. The margin on the new business is only 1.67%. Therefore, given the uncertainty, it would not make sense to accept the new business. Okay, let's do another example. Let's actually talk about the positive instead of the negative. If we come down over here, and let's call this now, we'll do 300, but now we're going to change this up a little bit. We're now going to say a 5, it's now 100. Now, look, that now becomes a different situation because by accepting the new business, I'm getting a lot more net income, and that's starting to make a little bit more sense. And we would accept the new business as the existing net margin is 20%, and the margin on the new business is 33%, is higher or is higher or at 33.3%, right? So this is not probably the right way to write this because I don't want to make it like a negative number. Okay, so let's just get 33.3%. Therefore, we should accept the new business. So again, use the numbers to tell the story. It's really, really important as you're going through and doing this. Another example here, and again, as we're going up and kind of describing these things. So for example, if sales basically went from 1,000 to 2,000, or I'll say 1,500, and then we'll go back down over here, my net margin or my net income is going from, say, like 100, and then here we'll say it's like at 200. And if I'm asking you, we'll describe what happened to sales. Well, what happened with sales in this very case? Well, you'd say sales went up. Well, so here's like what happened to sales. If I say something like sales went up, you are correct. Sales did increase, but we need to quantify it both in dollars and percent. So when we look at this over here, what we want to say is the sales increased over here by 500. So we saw an increase in sales of 500, but let's make this even better. The increase in dollars and then an increase in percentages, right? So if I look at this as a percentage increase, what's the percentage increase? Well, I'm going to take the amount of the increase and divide it by the original amount, the base year amount. So this is going to be 500 times 1,000 or divided by 1,000 or 50%. So my sales increased by 50%. How do I know that's right? Take your original sale, then say, well, if this increased by 50% or 500, My new sales, which are right over here, would now be at 1,500, right? So the way you want to kind of say this, the better explanation would be sales increased by 500 or 50%. That's what you can say. What happened to net income? Well, if you say net income went up, you'd be correct, but that's not going to be correct on my exams. You need to quantify it. So how do we quantify it? Well, we're going to take the difference between the 2 years. And in this case, the increase is going to be 100%. How did we come up with this? Well, the amount of the increase is 100. The base amount is 100. So what we can say is, and by the way, check our work. Net income was at 100. 100% of 100, which is the amount of the increase. I'm adding these two up, and I just screwed that up. Calls 100. So my new number is now at 200. So we want to say net income increased by 100 or 100%. That's how we want to go through and explain it. If it decreases, right? So if we get something over here where we get the opposite, meaning that we have, say, 750, and this is now 250, and we'll make this 600. And then over here, the net income was, say, 100, and then now it's going to go down to, say, 40, right? Over here, what I would say, well, what happened to sales? If we say sales went down, you would be partially correct, but you have to go through and show the percentages, right? So we're going to have a decrease as a dollar amount, a decrease as a percentage. So my decrease as a dollar amount is going to be 150. My decrease as a percentage, right? So I'm going to take this 150, I'm going to divide it by the original amount. Or in this case over here, this is going to be roughly 20%. This is going to be 150 divided by 750. How do I know I'm correct? Well, if my original amount over here was 750, if my 750 is decreasing by 20%, my new amount over here for sales is going to be at 600, right? So did sales go down? Right? So sales decreased by 20%, or sales decreased by 150 or 20%. That's what we're looking to go through and do. So again, as you're taking accounting 1B with me, no matter what the semester out there, which is managerial accounting for my classes, you want to make sure that you're going through and quantifying your explanations. And this is a really important skill set because, again, when we're going to be in the working environment, we don't want to say, oh, it's a great idea to add this new business. Well, it might be a great idea to add it, but we need to go through and quantify it. And, they may say, well, even though this business is losing money, we're still going to keep it around just because we like the business, which is fine. But again, this is really what you want to try to kind of go through and do. So I want to thank all of you for being with me here today. Appreciate any kind of questions you have on this video. And I look forward to seeing you on future videos. Have a great day.